Hey everyone, me Kevin here. Today I'm going to break down a really great piece by Howard Marks. He gives us some really good guidance on whether or not we should buy, hold off, or sell our stocks right now when it comes to investing. And to me, this also applies to what the heck we might be thinking about when it comes to the real estate market, just the broader market. Howard Marks is a hedge fund manager, and he's a co-founder and co-chairman of this company called Oaktree Capital. He also wrote this book on mastering market cycles, which I've read, and it was pretty good. Now, I don't agree with everything that Howard Marks says, but let's get into his letter, pull in some other information, and let's just talk about the market. Speaking of the market, make sure to get your 2 free stocks with Webull. Deposit just $100 with Webull, and they will give you up to $1,600 in free stock money. The link is down below, right next to the link for life insurance you can get in as little as 5 minutes. You can Apple Pay or Android Pay for it, and you don't have to talk to anyone. Okay, let's hit the highlights of this letter now that you've got your life insurance and 2 free stocks. First, Howard believes that right now, because of low interest rates, we've basically pumped up the prices of the stock market to a level where what we're expecting in terms of returns in the future is much lower than what it used to be. So obviously when we hear, okay, yeah, rates went down, Fed printed a lot of money, okay, great, stock prices went up, that sounds logical. But the second part is much more interesting. He says this isn't necessarily bad, but it does mean that we have to adjust our expectations downward for what our money will do in the future. This is really important because it's fun to sit in front of a compound interest calculator and say, wow, well, if I just put my money and put it into an S&P 500 index fund, it'll grow at 9.1% year over year for sure. Well, unfortunately, Mark believes that we're maybe not going to see the same growth rates that we've seen over the last 20 to 40 years. The past won't necessarily predict the future. And personally, this is why I believe we're going into what I call a frugal decade. Not only a decade where we see lower investment returns, like overall returns being lower, which makes sense in a lower interest rate environment, but also less spending across the board by people and potentially more investing, which both of those things lead to asset prices going up and returns going down. And right now, the companies that feel the most safe to invest into are, well, oftentimes those dreaded tech companies that just seem like they hit new highs every week. And you know, maybe that's because tech really is taking over our lives. I mean, we're gonna have robo-taxi soon. Soon we'll have robots that can go get Uber Eats for us from the restaurant, put it in the robo-taxi, and then we get it out of the robo-taxi when it comes here. So it wouldn't be a surprise to see a tech version of everything in the future. We already have a tech version of banking called fintech. We've got tech cars called Tesla and Neo, and who knows, maybe we'll even see tech real estate coming in the future. And this is where we have to be real with ourselves. We can't paint this rosy picture anymore of, well, if I just set my money and forget it into the S&P 500 index fund, we'll be fine. And we'll be able to capitalize on the same rates that we saw in the 70s and 80s when inflation was much higher. Now, this isn't to say don't invest in the S&P 500. It's just to say we should probably dampen our expectations for growth over the future. There's more money competing for less growth, basically. Marks goes on to talk about valuations in his letter as well. And he says when interest rates go down, asset prices go up. No surprise, especially stocks, because there are fewer other places to invest, and specifically he talks about bond yields. Bond yields are low when interest rates are low, so more people try to crowd into older bonds, but then those prices go up, and then people think about buying stocks or just holding cash, and then eventually buying stocks. Well, then, given the pandemic and the lack of other safer alternatives in the stock market, we really have this big concentration into tech. And this is where Howard Marks actually believes that, and I had to really think hard about this, he said that he believes the market today, prices where they are today, are fairly valued according to risk. And at first this got me a little bit shocked. I'm like, oh, okay, I mean, some of these valuations are a little, who picked that number, right? Well, then I got to thinking a little bit, I'm like, well, I mean, if we think about it, it makes sense that Delta and Carnival Cruise Lines and Wynn look cheap when there's a huge risk of these companies being saddled with debt for 2 to 3 years to come or more. We have no idea when this pandemic's going to end at this point. And it's also because, hey, when you look at a company like Zoom, which is sky high right now, you tend to see a little bit less risk in that company potentially going bankrupt. Now, potentially this is because society has just forced itself into a new way of doing business, that we've compressed the next 10 years of a transition to a tech world, one led by Tesla, Amazon, Apple, Etsy, and Zoom, and Peloton, into a world that has now fully transitioned in a matter of 6 months, or at least, well, the stock market has. I mean, after all, I did a video just the other day of me buying real estate in a Zoom courtroom. So it's almost like Zoom is becoming the new Xerox, which is a good sign for Zoom stock. But this leads a lot of people to say, well, come on, like Zoom and all of these other companies, this run-up is just being driven by unsophisticated retail investors, the Robinhood investors, and we can't trust those valuations. They're overpriced and people are just FOMOing into them. Well, so I did some research on that, and this is where I'm combining the Howard Marks information with my opinions and obviously this other research. The Wall Street Journal just explained via Jason Zweig's Intelligent Investor column that a lot of people blame Robinhood or retail investors on Zoom's run-up and some of these other tech company run-ups. Zoom's up 700% this year. However, according to Robinhood, Zoom was only the 49th widest stock owned on Robinhood. And of 25 stocks with market caps over $10 billion that have more than tripled this year, Moderna and Peloton are the only two on Robinhood's top 25 stocks. Peloton is a stock that I've been encouraging since April, by the way. I've really enjoyed that one's run up. But anyway, this Wall Street Journal article goes on to say that no, it's actually not Robinhood investors that are pushing these stocks to all-time highs because they're FOMOing. It's actually big institutions whose, quote, ownership of scalding hot stocks has boomed this year, even as those shares become widely expensive by traditional yardsticks. And index funds only account for about 19% of institutional buying. So that means you have a ton of massive institutions and hedge funds buying insane amounts of companies like Zoom despite these sky-high valuations. And Howard Marks has an explanation for this. Howard Marks calls this the bifurcation of the US equity market, a stock market. Leading tech and software companies have become more different from other companies, he says, as their role and power have expanded. He also says that they have become a larger part of stock indexes like the S&P 500. On the S&P 500, I personally believe that the S&P 500 potentially could be a little bit of a dying index. It's an index fund that values 3 tobacco companies as better investments or greater investments than companies like Starbucks and other companies like Disney. And I don't believe that the future that we see for the S&P will look anything like it used to be, but that's just my opinion. But Howard Marks goes on to say that 1/4 of the S&P 500 is now based on tech, fast growing, and an ability to increase profits and increase profit margins. Two very important things. Margins, very, very important for tech. But a lot of those tech companies are focusing on reinvesting in their businesses, so not necessarily pulling high margins, which makes the S&P feel artificially more expensive. You're really getting companies that are investing into the future faster now. And then talking about the leftover 2/3 of the S&P 500, Howard Marks thinks that those companies have already enjoyed maximum margin and they're now slow growth companies. Howard realizes that tech stocks also seem richly valued, but he believes that, quote, current profits severely understate the tech leaders' potential, and that their investments today help them increase their profit margins in the future. This is why he believes that larger PE ratios, price to earnings ratios, are actually warranted. But he does say that some of this can feel bubbly, because the reality is investors are valuing these companies way out into the future. And I kind of agree with this. You see this a lot. People are now, instead of valuing companies like 18 months in the future or 2 years in the future by looking at 2022, we see a lot of people going, well, Snowflake will be really profitable in 2030 when it has X billion dollars in revenue. Oh, Tesla's going to look great in 2030 when it hits this many car sales. It gets a little concerning. The further we go out, the harder it is to actually do realistic projections. Anything can happen, which brings up some serious downside risks. Howard Marks says we're not seeing inflation. We're seeing increasing debt as a country, and we might not see growth across the board for some time because of the pandemic. And ultimately, long-term trends show that we're becoming less productive as a country. In fact, Howard Marks quotes Federal Reserve Governor Bernard, who says we might see a downward spiral if we don't get another stimulus package to help us through this rough patch. And her version of a downward spiral is low rates, muted inflation, and weak growth. That's not good if she thinks that's a downward spiral, because all three of those things are kind of things that we're seeing. Weak growth outside of tech, low rates, and muted inflation. So we really get this mixed bag message from Howard Marks, and when we combine it with other information, it's kind of one of those things where it's like, great, so what do we do? Well, Howard Marks believes that our market has a lot of uncertainty right now, and actually believes that it might be best to play defense right now. He mentions that, quote, the odds aren't in the investor's favor, and the market is vulnerable to a negative surprise. Now, he didn't tell us what he thinks that negative surprise might be, and earlier he mentioned in his letter that he's cautiously optimistic. But from his 16-page letter, we can conclude that, hey, maybe it does make sense to take the foot off the gas a little bit and be a little bit more conservative. Let a little bit more income come in, stay away from margin and too much debt. But when it comes to buying into the market when we're ready, hey, maybe it's okay to pay a higher premium for some tech stocks, mostly because they might be the actual future. So following on this, I've made some modifications to my strategy. I'm no longer buying individual stocks. Instead, I've expanded my 1337 portfolio to include 40 stocks instead of 30, and I've flattened my allocations out a bit to spread and diversify my new investments. So I did buy stocks this morning, and I bought some over the last 3 weeks, though at a much slower rate than I've usually been buying. That's mostly because I've been paying off debt, paying off margin instead of buying new stocks. And I've also already paid off all of my credit lines, and I'll draw on these as I need to buy real estate. But right now, it's a good feeling to know, hey, if the market crashes big time, you're not exposed to a big margin risk, and you could always take out some credit lines and buy stocks if you wanted to. But in the meantime, every time I get paid, I'm kind of looking at, well, if debt's paid off, I've got money in the markets, I don't need it for a while in the future, maybe it makes sense, especially with all this information we got here, to just buy our favorite high-quality stocks. Don't expect insane returns, but just get in and wait. That's my thought and update on the stock market for today. Thank you so much for watching this. If you like this, consider checking out the courses down below where I go really deep into analysis and fundamentals and my strategies and theories. I think you'll really enjoy them, so check those out in the description down below. Use that coupon code. You can always email me to bundle up as well. And folks, we'll see you in the next video.